We are now over 2 years into the coronavirus pandemic. While everyone has been affected by the pandemic in some way, the Tennessee Homeowner Assistance Fund, or TNHAF, is a resource for those homeowners who experienced a financial hardship related to the pandemic. If the coronavirus pandemic has made it hard for you to pay your mortgage, you're not alone. Know that help is available. There are many options available to you. Because you're watching this video, you have already reached out to your state and are in the process of applying for some relief available under the TNHAF program. But know that TNHAF is only one of your options. Other options might be available to you. Whether you're facing COVID-related hardship or even under normal circumstances, you may be eligible for loss mitigation with your existing servicer. Some loss mitigations do not require a lot of paperwork, so it's important to reach out to your servicer. Forbearance is one of the most popularly used loss mitigation options during COVID-19 through the CARES Act of 2020. Forbearance allows you to temporarily reduce or pause your payments, but this relief is not automatic. You need to contact your mortgage servicer to find out what options are available for you. The CARES Act covers loans backed by the federal government. If you have a privately held mortgage, many servicers still offer forbearance or other relief programs. Your missed payments need to be repaid, but not in one lump sum. If you are requesting forbearance, understand how you will need to repay the loan once your relief period ends. For most loans, servicers cannot require you to repay all at once. When you talk with your servicer, ask how and when you will need to cover your missed payments. If you are eligible for CARES Act forbearance, you are not required to show proof of financial hardship. When you request mortgage forbearance, just tell your servicer that you are going through financial hardship because of the pandemic. You won't need to show proof. In fact, your servicer isn't allowed to ask for it. If you're applying for TNHAF assistance, there will be some documentation required to show your hardship is eligible. You don't need to pay for mortgage relief, no matter what kind of mortgage you have. If a company offers to help you work with your mortgage servicer for an upfront fee, it's likely to be a scam. However, if your mortgage company is trying to reach out to you, please don't ignore them. They may be trying to help you. If you know there's a certain amount of time available to you by which you know the hardship will be over, don't exhaust the time available in your forbearance when you may not need to. Even if you're under agreement not to pay anything during a forbearance, if you can afford to pay something, please do. It can reduce the amount you owe at the end of forbearance period so you can catch up a little easier. With forbearance, keep in mind that under the CARES Act, there should be no negative impact to a borrower's credit score for payments missed during an approved forbearance period. but please understand that your credit report will reflect the status of your mortgage as forbearance, which could impact a creditor's assessment of your situation. Loan modification, which is often called loan mod, is another loss mitigation tool that may be available to you. Through a loan modification, your servicer changes the original terms of a mortgage in a delinquency status. Modifications can extend the term of the loan, reduce the interest rate, reduce the principal either through principal forgiveness or principal forbearance, or a combination of these changes. Please note that a mortgage servicer considers many factors when determining if a borrower is eligible for a modification. Typically, you will be asked to prove your financial hardship to qualify for a loan modification. Depending on your situation, you may be able to do a refinance. This typically requires a credit score high enough to qualify, and if your mortgage loan has been reported late to the credit bureaus, this may not be an option. Let's go over the difference between a refinance and a modification. A refinance is typically done to lower the interest rate and to shorten the term of the mortgage. It could also be to tap into your equity and do what is called a cash-out refinance. The mortgage is normally current and a loan officer is normally involved. A loan application is part of the refinance. A refinance can be done with your current lender, but a lot of times people refinance their existing loans with a new lender. By contrast, a loan modification is done with your current lender. The mortgage is normally behind, and your current lender's loss mitigation department is normally involved. A loss mitigation packet, also called a hardship packet, is part of the loan modification process. Both a refinance and modification are recorded at the courthouse. Proceeds of the refinanced or modification loan take the place of the original mortgage. The Department of Housing and Urban Development, or HUD's Partial Payment of Claims or Partial Claim Program, has typically been a loss mitigation option for FHA loans, but other government agencies are offering something similar due to the pandemic. It involves FHA or another government agency insuring the mortgage. The servicer uses a portion of the insurance fund to reduce the principal on a delinquent mortgage to reduce the monthly payment for the borrower. In a partial claim, HUD secures repayment from the borrower by placing a junior lien on the home, which must be paid in full when the loan is paid off or the house is sold. Unfortunately, there are times when borrowers do not qualify for any loss mitigation options, or when borrowers cannot sustain their mortgage payments even after they've exhausted their loss mitigation options. As a last resort, you can look into a couple of disposition options available where you can dispose your home. Disposition options such as short sale and deed in lieu can be a more effective solution for you than foreclosure. They tend to impact your credit less than foreclosure. Within 2 to 3 years after short sale or deed in lieu, you might be eligible for a new loan. Foreclosure might require a longer wait time for you to be able to receive a new loan. When considering other options, first understand the market value of your home. Are you able to sell your house at a price that is sufficient to cover the outstanding mortgage principal you owe to your lender? Consider speaking with local real estate agents who understand the market conditions of your area well. Make sure that you are well informed of any commissions or fees you need to pay for the transaction, as well as any repairs that may be needed to your home in order to sell. If your home price is not sufficient to cover your mortgage principal, short sale might be an option for you. In short sales, you're allowed to sell your home for a price below the outstanding unpaid principal balance. However, a short sale needs to be approved by your lender, which could turn into a complex process since there might be multiple investors who own your mortgage behind the scene. In addition, a short sale by itself does not relieve the borrower from the obligation to pay the remaining loan balance unless the owner of the mortgage, which is the investor, waives the deficiency. Deed in lieu of foreclosure is another disposition option. A foreclosure alternative under which the borrower voluntarily transfers ownership of the property to the mortgage owner in exchange for a release from all mortgage obligations. This option will affect credit, but may be viewed more favorably than a foreclosure. Then there is foreclosure. Foreclosure is the legal process used to resolve a distressed mortgage so that the servicer can sell the property securing the loan and use the proceeds to satisfy the loan. The borrower's ownership interest is removed. Keep in mind that a foreclosure will affect your credit. If you need additional help, housing counselors certified by HUD can provide free support. And call your servicer and ask for your mortgage relief options. Don't wait to make that call. Help is available to you. Act now by contacting your mortgage servicer. This section has been designed to provide some useful tools and resources to help you prepare for different things that you may face in the future as you are coming out of the COVID-19 pandemic. It all starts with goal setting. Goals help you prioritize how money is spent so that it goes towards the things that matter for your future. Goals, especially using the SMART goal framework, can help you track your progress towards getting the things you want. Let's go over SMART goal framework. SMART means that the goal itself is written in a way that is specific. A specific goal has a much greater chance of being met than a general goal. Measurable means that you should be able to track progress towards meeting the goal. The goal should be achievable. Relevant, which is a goal that matters to you. And time-framed, which means that a goal has a clearly defined deadline. Once you have defined your goal according to the SMART framework, now you can create an action plan. The plan helps you break the goal down into smaller steps that you can achieve, as well as think through about the resources you need to achieve each step and the target date to complete each step. When all the steps are taken, you should reach your goal as planned. For example, let's say my goal is that I want to pay my bills on time every month starting August 1st. Assuming that the lack of money is not the primary reason my bills are not being paid on time, here are some steps that I might sketch out in my action plan. First would be to collect my credit card statements, loan payment statements, utility bills, phone bills, and documentation of other payments that I make each month. Step 2 would be to go through those statements and highlight payment amounts and due dates. Step 3 would be to mark up a calendar so that I have a visual as to when my bills are due and how much is due. Step 4 might include setting up automatic payment methods for some recurring bills or online bill payments. So again, creating an action plan is about breaking a goal down into steps. It's an important part of goal setting. Let's discuss savings. How would you define savings? We define savings as money you set aside today from your income for use in the future. The savings you create today will come in handy for any unexpected expenses or emergencies in the future. You have probably heard about 3 to 6 months worth of living expenses as ideal savings you should attempt to create. For many of us, that feels like an impossible goal, so we don't even try. By contrast, $500 to $1,000 does seem possible for many of us. And you will be surprised to hear that a lot of different emergencies or unexpected expenses can be handled by $1,000. Let's talk about creating a savings plan. Think about why you are saving and write it down. Think about the amount you need to save and write it down. And also write down how you are going to find that money to save, as well as where you're going to put that savings. Plan to move the money that hasn't been spent into either a jar or a shoebox or a savings account, or even onto a prepaid debit card to count as savings. It is important to set aside that money that hasn't been spent so that you don't spend it on other things. That's how savings are generated. Let's discuss budgeting. Creating your monthly budget starts with documenting your income and expenses. Getting the total picture of your income and expenses helps you plan your budget going forward. 2 categories of income are income and benefits. Income can be regular, irregular, seasonal, or one-time only. Examples of benefits are food stamps and disability benefits. An income tracker is a tool to help you gather this information. This tool will help you understand when you can expect the income and how much to expect from week to week. It's common in families with limited resources to have multiple sources of income and financial resources that make a patchwork of income to support the household. Moving on to expenses. Again, understanding the total picture of your expenses helps you plan your budget going forward. Consider using the expense buckets listed in the Spending Tracker tool. The categories include savings, debt payments, housing, utilities, household supplies and expenses, groceries, eating out, transportation, healthcare, personal care, childcare, entertainment, court-ordered obligations, as well as gifts, donations, and other expenses which is really a catch-all category. Use the expense buckets to track your monthly expenses. Document where you are spending your money and where you might want to make some changes. There are some strategies for cutting expenses. Think about cutting back on regular, recurring expenses, such as cable, phone, internet, and so on. Once you have income and expenses documented and have gone through the process of maximizing your income and cutting expenses, you are ready to set your cash flow budget either weekly or monthly and start tracking your cash flow balance week in and week out. There might be some weeks you're out of balance. When cash flows don't balance, there are 3 basic solutions. You can increase the source of income, decrease your spending, or figure out ways to match the timing of sources of your income and spending. Here are some strategies for adjusting the timing. Negotiate new due dates for bills to better line up with when you get income. Negotiate splitting a monthly payment into 2 smaller payments. Avoid large lump sum or periodic payments by making monthly payments rather than quarterly or semi-annually. This may increase the total cost, but it could make it more feasible in terms of covering the payment on a monthly basis. Now, let's discuss debt. There are some good aspects of debt as well as bad aspects. For example, some debts help you create a credit history so that you can improve your credit score. Start your debt management by creating a list of all debt, money you owe to someone else. Collect all of your bills for each debt and record them all in one place. Document the person or organization you owe money to, the amount you owe, the amount of your monthly payment, as well as the interest rate you're paying and other important terms. This process will help you gain a realistic idea of all debt you owe. As a next step, consider calculating your debt-to-income ratio. It's a simple calculation that shows how much of your income is going towards paying debt. For example, if your debt-to-income ratio is 40%, that means 40 cents out of every dollar earned is going to pay for debt, and that 60 cents is left over to pay for other living expenses. To derive your debt-to-income ratio, simply take the total monthly debt payment and divide it by your monthly gross income. Gross income refers to pre-tax earnings. There are some examples of debt-to-income ratios you want to consider as the maximum level. If you are a homeowner, consider maintaining a debt-to-income ratio of 36% or less. Let's discuss credit. Your credit reports and scores are used by a wide range of purposes. Banks can use them to decide whether to give someone a loan. They could use it to decide the interest rate on that loan. Credit card companies use credit reports and scores to determine whether or not someone will get a credit card, and again, the rate they may pay. Cell phone companies or utility companies may use them to screen people for deposit levels as well as cost of service. An insurance company may use them to determine whether to provide someone's insurance coverage and the rates they will pay for the coverage. 3 major credit reporting agencies are Equifax, Experian, and TransUnion. You can get your free credit report by going to www.annualcreditreport.com. Do not Google free credit report or free annual credit report, as there are many other websites that might charge you for the report. Make sure you go directly to this website by typing this URL. It is important to understand that budgeting and crisis budgeting are two different things. Crisis budgeting relates to cutting down your budget just to the bare essentials. You will have to review each expense category on your budget and draw a line between essential items and non-essential items, the line between what you need and what you want. Crisis can take different forms, so you may want to consider different scenarios and create a crisis budget for each possible scenario. If you've remedied your crisis, be sure to assess it and determine if you still need to set money aside for any other situations, since you may not have TNHAF, forbearance, or other assistance available to help you out. Create that savings account we looked at and start putting money away for the rainy day. Congratulations on completing the education video. We hope it provided you with some valuable information. Please reach out to your assigned counselor to schedule a consultation call with them. They will be able to answer any questions you may have from the video and about the next steps in this process. This call will be required to be completed before any disbursements can be made on your application.